Today we're going to be covering stock. A lot of you have probably grown up hearing about the stock market. Maybe you have some understanding of it. Maybe you own some stock. But a lot of people really don't understand the stock market. So we're going to give just some basic introduction, do some journal entries regarding stocks, and we're going to cover this in this lecture. So basically what happens is that over the years, obviously we've had sole proprietorships and then partnerships, but they had a lot of liability attached to them. I mean, if the company goes bankrupt, then not only can the sole proprietor be responsible, but they can also take not just his business assets, but his personal assets. So people didn't like that. So corporations were invented to try to help curb that a little bit, because obviously that is very scary. That's called unlimited liability. Corporations have what is called limited liability. You can only lose what you invest in a corporation. So if I go out today and buy $1,000 worth of stock in UPS, and UPS, God forbid, goes bankrupt tomorrow, I can only lose the $1,000 that I invested. With that stock, I actually become an owner of that company. Now, a lot of people believe in what's called preemptive right, and it's true. Preemptive right says that you have the ability to vote or have a say in running a company if you own shares of stock, even one share of stock. Most people don't exercise their preemptive right unless they're a significant stockholder in the company. For example, I have a 401k set up through my work, and a lot of times with your 401k, you own a little bit of stock in a lot of companies. So I don't feel like I'm familiar enough with any of the companies that I own stock in to actually go and vote at the board of directors meeting or go to a stockholders meeting, but some people can. And if you own a significant amount in a company, it is your preemptive right to be involved in decisions for that company. So by all means, you should exercise that. When you own stock, you get a stock certificate. On that stock certificate is going to be how many shares you own and the par value. Now the par value is different than the market value, so we need to discuss that today. Basically what happens with most stock is that they have what's called a par value. A par value is the minimum amount that a company would take for that stock. A lot of companies use $1, $5, something very low. Market value is what you're probably more familiar with. The market value is the ticker tape that goes around all day long while the market is open and the stock is trading, and it changes. If you've ever watched the stock market, it changes quite frequently, actually. That's called the market value. So I put up on the board some journal entries to show you how stock is put on the books and then what happens when the market value increases. And obviously we hope it increases. That's what companies are looking for. When a company puts their stock out on the stock market, as soon as someone buys that stock, they get cash. So this is a super easy way for companies to raise cash without having to go to a bank and signing up for a loan, sitting around waiting for the loan, maybe not even getting approved for the loan. So stock is a really nice option for corporations when they need cash. And even if they don't need the cash, they can put it aside for later, right? Or to do a special project, or to expand globally, or make a new product. Whatever they want to do with that money, it's their decision and their right to do it with it. So when companies first put stock out there, let's say that you have 1,000 shares of $1 par value stock, and you put it on the market and somebody gobbles it up, but the price hasn't changed. The market value and the par are the same. Then your journal entry would be to debit cash, credit common stock for $1,000, $1 par value times 1,000 shares. As the stock goes around the ticker tape and people see people buying it, the price will go up. When that happens, I put this example down here on the board. Let's say the same dollar par value stock, you sell 1,000 shares, but now the market value is $5, so it's gone up. So this is exactly what companies want to happen, because this is great. They put those 1,000 shares out. First, they got $1,000 for them. Now, because the market price has been driven up to $5, they get $5,000 of cash, which is wonderful, right? So it went up. Here's the deal. You always put common stock on the books at par value. So it doesn't matter what the market's doing, common stock will only show you par value. So that's kind of nice because you have a base to see what was your minimum. And so common stock's always going to show the minimum amount you would have taken for it. The difference between this, because as you all know, we can't do a journal entry where the debit amount doesn't equal the credit. So that would look really weird if we did that. The difference amount is this new account. It's called, some people just call it paid in capital. Its total title is actually paid in capital in excess of par. Any money above par value that you collect for the stock, goes in this account. So we have par value of 1,000, but we collected cash of 5,000. The excess or the paid in capital is called $4,000. So 4,000 plus the 1,000 equals the 5,000. So both the debits and credits equal each other. And this account shows you the excess above par. So when you look at a company's book and they have a big number in paid in capital, that means that people like their stock and they're buying it for more than the company was willing to accept for it. So that's really nice. You can see if you look in the paid in capital account how much people are enjoying this company's growth and trusting in their stock. So it shows a sense of confidence. If you open a company's books and they don't have paid in capital or they have very little in there, then you know that their stock's not really taking off the way that you would like to see, especially as an investor, if you're an investor. The next part of the chapter talks about dividends, and we certainly need to cover dividends. We've talked about dividends in previous chapters. This chapter talks about why do you pay dividends, and we've kind of hit on that a little bit, I think. But dividends are when you want to share some of your earnings with your investors. So all these people have been buying your stock, and that's wonderful, and it feels so good when they do that. Why don't we share a little bit back with them? A marketing person invented dividends. It's actually a genius idea. The thought behind dividends is, hey, let's share a little bit with them, but guess what most people do with their dividends? A lot of people buy stock with them in the company and just put it right back in the company. So it's actually a win-win for the company. It's like, hey, I'm giving you this. I look so successful that I'm able to give my investors money, and then the investor goes and puts it right back in the company. So it was a really good marketing idea from a marketing guru, and it works. Now, some people obviously will keep the dividend and spend it on their own personal stuff, and that's fine. But if you get some of it back, that's really nice. Plus, it just looks good, and it looks like you have a good, strong company if you're able to pay dividends. The chapter also talks about stock dividends. You don't have to pay out cash to pay a dividend. You can actually give people more shares of stock. Some people like that, some people don't. I guess if you look at it, from the perspective of if it's not a very good stock, then you probably don't want more of it. But if it's a really strong company and they're doing really well and you get more of their stock, then you're just super happy, right? So stock dividends are another marketing idea. Now, what is a bit of a problem, and the chapter talks about this, is if you normally pay cash dividends every year to your investors, and then one year you decide to give stock dividends instead, you're probably going to have some upset people because they've been used to getting a check every time, and then all of a sudden it's like, poof, no check, but I get stock. I don't want stock, I want a check. So you need to be really careful. If you've conditioned your investors to get a cash dividend every year, be really leery and careful about slipping in a stock dividend because they may not like that and they may withdraw their money in your stock completely. So you want to be really careful about that. Dividends are a marketing idea, so use your brain and think about the marketing concept when you're thinking about how you're going to share your money with investors. The next part of the chapter talks about treasury stock. So common stock is when we're putting our stock out there and somebody is buying it outside of the company and giving us cash for it. Another topic that before we talk about treasury stock that I should say is there's also a section called preferred stock. Preferred stock just means that the person wants to pay a little bit extra for the stock because they want to be first in line for dividends. So let's say it's a retired person and they live off their dividends. Well, they don't want to miss cash dividends, and if they have a company that normally pays them, then they may pay even extra for the stock and call it preferred stock because they want to be first in line for dividends. A lot of retired people live off stock dividends, so they may do the preferred stock. And the journal entries for preferred stock are exactly the same as common stock. The next level of stock that we need to talk about is treasury stock. And if you notice, treasury stock transactions are the opposite of common and preferred. Common and preferred, you're actually receiving cash for your stock. Treasury stock is where a company goes and buys stock back off the open market. They buy their own stock back off the open market. So this is a little strange. You might think, well, why would somebody do that? There's usually a couple of reasons why a company will do this. One of the main reasons is to give holiday bonuses at the end of the year to their employees. So if I'm a company and I think, I'd like to reward my employees. We've had a really good year. What could I do for them? Maybe I don't want to pay cash, but I'll give some of my stock to them in the company. Also, it's a really good idea to have your employees be stockholders in your company because there's more of a marketing buy-in. It's like, oh, I'm an owner in this company, so of course you want the company to succeed if you own a portion of it. So it could be for that. Back in the late 80s, early 90s, you heard a lot of treasury stock transactions to prevent takeovers. Takeover is when one person owns over 50% in the stock in a company. You don't really hear about that very much anymore because it's so easy to buy and trade stock. You could do it on your phone right now if you were so inclined. Also, stock is global, more so than it ever had been in the past. And so it's really hard for one person to get a large portion of stock. I mean, most companies are owned by a ton of people, not one or two people. So you don't really hear about it as much for preventing takeovers. The majority of our treasury stock transactions now are companies going to buy their stock on the open market to hold them and give them back to employees as bonuses. So a couple things we need to talk about. The journal entry to record treasury stock. So let's say I go out on the open market and I buy 1,000 shares of my own stock, and at the time it's trading for $10 market value. I put it on the books like this. I debit treasury stock and credit cash, because remember, I'm buying my own stock back. So it's the opposite of common stock. When I go and buy it back, I debit treasury stock, credit cash for the amount of shares times the market value, the current market value. So that would be it, and you would be done if you were doing a journal entry to just buy that back, and then you distribute those shares out to your employees and you move on with your life. Let's say, because we have to show you the scenario, of you change your mind. You decide, I'm not going to give these Christmas bonuses or holiday bonuses because maybe you decide to be Ebenezer Scrooge and you don't like your employees anymore or something bad happened. I don't know. First of all, what do you do if the market goes up? So you bought the shares at 10, but now the market is 12. If that happens, then you're going to make money off your stock, which is great. So you record the cash, 12,000, because it's 1,000 shares times $12. That's how much cash you would receive if you put them back on the open market. Treasury stock, the par value becomes what you purchased it at. So 1,000 shares times the $10 that you purchased it at up here. The difference between that is called paid-in capital in excess of par, just like it was for common stock. So the 2,000 extra dollars you made, that's a gain. That's a good thing. The bad scenario would be this situation down here. So you bought the treasury stock at 10, but what if the market went down? Now, I will tell you in practice, I've never seen anybody do this because this is losing money on yourself. So you would just hold on to it until the market value goes back up. But let's say you're desperate for cash. So you go to the open market and you say, oh my gosh, I need cash right now. So here's my 1,000 shares and the market's paying 8, fine, I'll take it. That means you would only collect $8,000 cash. The treasury stock has to go off your books at what you put it on, so you have to take the $10,000 off. And look what happens. 8 plus 2, I need a 2 here. You debit paid-in capital of excess of par. This is the only time you are allowed to debit paid-in capital. Paid-in capital is supposed to be a good gain account. It's a credit. It's supposed to show a gain. It's like revenue coming into your company above what your minimum was. Uh-oh, we're debiting it. If you debit it, that's a loss. That's a bad thing, okay? So this is debiting paid-in capital. We don't want to do this if we don't have to. You must be really desperate for cash to do that because it's basically losing money on yourself. So I'll be honest, I've never had a client actually do this, but we have to show you the scenario if the market value went down. Normally, in a normal world, people would buy the shares and give them to their employees and you wouldn't worry about it. But if something happened and you had to get rid of them, let's hope for this scenario where the market value went up, not down. That would be very bad. So today we've talked about common stock, putting it on the books. We've talked about dividends. We talked about treasury stock. There's a lot of information in the stock chapter, so take a look at it and try your homework, and hopefully these journal entries will help you. Thank you.